think Intel, Google, Intech are folks that have come up with a set of rules whereby they can participate without creating friction at exit. We think that the green premium that I think a lot of founders and investors thought customers would be willing to pay turns out to be quite hard to get customers to pay for.
All right, today we are having Shaun Abrahamson on the pod again. He's the first guest to make it on here 3 times now, so for a good reason, as you'll see. How are you doing, Shaun?
I think apparently I'm just long-winded.
Perhaps you've got a lot of good ideas too. Maybe, don't sell yourself short. Today what we're going to do is we're going to be effectively kind of recapping the event that Third Sphere put on during Climate Week, titled ClimateTech Exits. It was a really, really beloved event for good reason, as you'll see. There's a lot of people who could not make it, so we wanted to recap that, plus kind of carry on the conversation slightly beyond that. So before we do that, for anyone unfamiliar for who you are, Shaun, can you just give like a little bit of a TLDR version on Third Sphere and your history so they can understand the credibility behind this?
Sure. So Third Sphere focuses on primarily mitigation and adaptation focused startups in climate. Usually very early stage. So I think roughly the way we've communicated is probably have a bad logo, an excellent team, a questionable demo. That's kind of, and no customers. That's kind of our sweet spot. And we've done some variation on that. We've roughly been doing that for 10 years. And so it's got us to about 100 investments, maybe some things that are unusual, at least historically they were unusual. We spend a lot of time on sort of non-equity fundraising. So we've always helped. I think the stat we have is 50% of the leads, in follow-on rounds come from our introductions, but that's on equity. We spend a lot of time on non-equity. One of our concerns is that at the end of the journey, which for a lot of people means that they're selling stock, especially the common stockholders, so the founders and the team should get paid, and that has been less and less common, let's say, in recent years in VC. So it's more important to do the work on things like grants and loans and things like that. We do a lot of hardware. So we've had a thesis since very early on that not only can you build very valuable hardware companies, most of the most valuable companies in the world today, certainly the tech ones, do hardware and software. But in climate, that's especially required. Like, it's very difficult to influence the physical world if you're not actually doing stuff in the physical world. So not to just software, but it's software and very often. And then maybe the other thing is, stuff that we try not to do, right? So there's a lot of work on first of a kind. We have a thesis on getting to revenue very quickly, which is related to the non-dilutive thesis. And so there are a lot of things we would like to do and we think will exist in the world, but probably not.
Yeah, no, that makes sense. Thanks for that. I guess you could say recap. If you guys have not already heard the episodes that we did with Shaun, you can check them out, 136 and 176. The first one is more focused on Third Sphere, and the second one more focused on some different topics around partnering with oil and gas, and then putting a financial, I guess you could say, number on climate impacts. That was a pretty fun episode, I will say. So let's get into the meat of this then. A lot of people talk about why exits are so important in VC, but could you just give us the quick kind of reasoning as to why it actually matters and how the system works itself?
Yeah, so I think if we think about how climate solutions get built and deployed, there's certainly policy help, but the things that are getting helped are mostly private companies. And those private companies are being funded mostly with private capital. There's a percent of that private capital that will always invest no matter what the return is, as long as they have money. If you give them $1 back, they'll put $1 back into climate, but that's a very small percent. Most of the investors are investing in climate, but they are also looking at things like AI, they're looking at things like biotech, healthcare, etc. So it's a competitive market. Ultimately, there can be good press, there can be, we can be excited about things like EV adoption, etc., etc. But what most of the private capital investors are looking at is money coming back, which is to say, are they able to sell stock at some point, which usually happens in a few ways. You IPO or you're acquired. Or we'll talk a little bit about secondary market. And what we've done is we've sent a lot of money out into building things and very little has come back. And so there's a risk that at exactly the moment where we really want to ramp up, there actually isn't that much interest from private capital. Interest is probably the wrong word, I should say. there is interest. There just isn't a lot of capital because it has other choices.
Yeah, no, that makes sense. So in general, if we can't have exits, because of the LPs in the market. They're not going to see the returns, the majority of them at least, and they're not going to continue to invest in climate is the short answer. So that's why the whole capital cycle has to work, and the VC's role
Right.
in kind of being
Yeah,
that
in the
intermediary.
ideal world, I think what happens in VC is you say you're aiming for something between three, if you want to be in the top 25%, five, if you want to be in the top few percent, a multiple of 3 or 5x the original investment after
Hmm.
all the fees and everything else.
Yeah. Okay.
And so practically what you would like to have happen is return 3 or 4x the investment, have some percent of that, maybe half, maybe a third, come back into climate. So just thinking about that as a cycle of reinvestment, you can't do that until you distribute in cash.
Yeah, understood. So, and then I guess in the presentation, you guys set the scene with a number of, there's a lot of slides that we could talk about, but I wanted to just offer to you what were the core things that you think are important to bring up for kind of the state of climate tech exits, if you will.
Yeah, I mean, I think it's sort of good news, bad news, or well, it depends what you like first. So we'll do the bad. Maybe the bad news is, there just hasn't been, the IPO market is effectively closed. I think the good news, to the extent there's good news, is that's not just a climate problem. Related to that, I think for a while we were hearing from LPs that there was a lot of climate SPAC activity. A lot of that activity has gone to zero, meaning companies listed and ultimately are worth nothing. So depending on what you're looking at, there's, Bird, Proterra, there's, we don't have to name, but just to give you a sense, folks will, if you go and look at those stock tickers, it's very unhappy. I guess the good news is that is not a climate specific thing. That is a SPAC specific thing. In other words, if SPAC was used as a funding vehicle, anything that used that, and literally every kind of company was using that, climate isn't really overrepresented. So again, I think what we're looking for is, ideally, this is not a systemic climate problem. This was just a finance problem. So I think that's been the big one. I think, some of the more positive things, there is M&A activity. It seems quite narrow still, meaning we're talking about things like renewables, like very mature. It's not the kind of stuff. I mean, there are some VCs investing in variations of, let's say, solar deployment in India, right? So it's not to say that solar isn't attracting VC. There's some, but it's by far the minority. But that's the bulk of PE, and some of that may just be a lag, right? Like we those companies are relatively mature. If you go back and look at when Sunrun or Solar City went public, we've had enough time elapsed, so it's not a total surprise. I guess the good news is that CVCs are super active in general.
Mhm.
They seem to be especially active in climate, and they're active from very early on, meaning they used to show up at Series A and B. They now show up sometimes at pre-seed, but usually at seed. Having a CVC on the cap table just increases your probability of having M&A discussions. That worries some investors, I think, but overall, that seems very positive, right? There's some correlation between that activity and the exits that will happen, whatever, 7 or so years later after seed.
Yeah, can you talk about why some investors are worried about that? Or are they just worried about getting bought too early before the valuations go up?
Yeah, there's certainly that. I mean, we've had that experience. It's sort of a tough conversation with the founder who said, I really want to go and do this thing. Very often for founders, it's great, right? Like they can take $5 to $10 million off the table if it's early. For investors, I think at sort of 2 or 3, even 10x, it's nice, but that's not it. When we think about investing, we are really thinking about things that could be 50x, right? Because
Mhm.
the math for us always comes back to 1 or 2 companies, probably one, that pays for everything.
Yeah.
And so don't want folks to get off the ride too soon, right? Like keep your arms and legs and go for the full ride. So that's one. I think the other is there's some really good examples. I think Intel, Google, in tech, of folks that have come up with a set of rules whereby they can participate without creating friction at exit. And
Mhm.
what could friction look like? Well, if you are on a board, let's say you Google, and Apple decided to come and make an offer. Well, Apple may not even make an offer if they thought Google would see it.
Mhm.
So
I see.
so so you're losing some optionality to exit, or Apple might actually make an offer and then Google could complicate it by countering, in which case, now that VC has to go back to Apple, or that investment bank has to go back to Apple and say, I'm sorry, we didn't realize we're going to start a bidding war. There's a lot of variations of that. In the tech world, it's settled down. You wouldn't have Google on the board because they understand that complicates things.
Yeah.
So what happens I won't pick an industry, but let's just say outside of tech, the level of experience working with tech is lower, not a shock. And so there's generally nervousness about taking the time to educate a CVC about what can they actually ask for, right? So let's say I'm in the cement business. I found a cement company that I'm very excited about. I'm actually going to be their first customer. I'm going to put in some money. Well, I created a lot of value, right? By being the customer, I've actually validated and increased the value of the company. I should probably get something else. Totally not unreasonable. The question is, what else can you get that still allows the company to grow? And that's very often where things get sort of interesting, is you have a customer or a supplier that wants to play multiple roles, and they're not actually sure what's reasonable to ask for.
You know that feeling when you meet someone who shares your vision for the future? It just clicks, like two peas in a pod. Well, that's exactly how we felt when we met Goodwin, who we are proud to have as our sponsor.
Being the first major law firm to set up a climate-specific startup and venture practice makes them exactly the kind of partner we are excited to work with. They realize that there are a plethora of challenges to building climate tech startups, and that's why they have built an entire suite of resources for founders, investors, and entrepreneurs in the space. They even offer several tailored pricing methods. And guess what? It doesn't matter where you are listening to this. Goodwin is a global law firm that you can trust to be your partner through it all, from incorporation to exit. They've got you covered.
Go to goodwinlaw.com and tell them Clean Techie sent you to get exclusive access to startup resources. All right, back to the show.
So you guys probably spend a lot of time talking to your founders about that because you've seen it a few times now.
Yeah, I mean, you got to remember the goal for when corporates are investing. If you do that, if you took a deal that we would consider to be excellent, founders, VCs, etc. If you made 100x on your initial investment, right? So turn $1 million into $100 million. Very exciting, right? Everyone's happy. Unless your business revenue is in the tens or hundreds of billions a year, in which case, who cares, right? That's not the reason to do it. What you would like is, rather than the 100 million, in return, is to have a business that you could buy that would generate revenue for years and years in the future, or block one of your competitors from buying it. They are blocked. So that, I think you have to remember why folks are in the game. And then I think you have to remind founders that, yeah, your contract that you're doing today is nice, but it may not be worth certain concessions. And yeah, just reminding that like financial investors like us are not always aligned, right? We just care about different things. So
yeah,
there's a fair amount. I think also like it's hard for founders because they're having to master a lot of stuff, right? Like they're going and learning about customers. Great. Some of them already know their customers in detail. They come from the industry, whatever, but you've got that. Now you've got to learn about VCs. Again, maybe you're a second-time founder, you know a little bit about VCs. Then you've got to meet corporate development people who are like a whole other breed of characters, and so you got to understand their incentives, their motivation, the style of work, how to negotiate. They often negotiate against themselves. They're telling you they're going to help, and then they're asking for terms. So we do spend more and more time, and I think like what we've noticed certainly more recently, like post 2021, as part of an overall venture correction, there's much more CVC activity in our portfolio.
Mm-hmm. Yeah. So just to try to recap it, so the kind of current state is things are down across the board. It's not just climate; it's kind of across tech in general. And there is more M&A activity happening, or there still is some activity happening, but it's happening earlier where CVCs are getting involved, which kind of presents a couple different future opportunities. Did I miss any core pieces there before we move into what the future might look like?
No, we can keep rolling.
So I guess on that topic then, what do you see as a potential kind of future opportunities, or how might things shape up from your perspective?
Yeah, I mean, I think, do we want to do election predictions? Can do.
Sure.
No. I'll stay away from that. I mean, I think there's some parts of the IRA that probably don't get affected, and that is important, right? Like I think there's a certain part of climate, there's certain types of deals that are getting underwritten because of that. And so, it should remain robust. I think the parts that are safe have to do with the tax code. The
Mhm.
parts that are maybe less safe are more explicit subsidies for things like heat pumps. So, I think it's not broadly a climate challenge, but there may be, depending on which way things go, there may be challenges for some subset. On the M&A front, there's a current sort of policy environment where deals are not getting to the end. They're being scrutinized and reviewed and abandoned at a rate that hasn't happened before, right? So it could be antitrust. It's not a US thing only. It's happening a lot in Europe. But on the one side, we're encouraging people to build things, and then at the end, we're discouraging people from buying them. So there's some, and I don't know, that second thing could swing more wildly depending on what happens. Like that, so trying to place bets. There are a few things that are dependent on the election. I think independent of the election, we think that the green premium that I think a lot of founders and investors thought customers would be willing to pay turns out to be quite hard to get customers to pay for. So I think in EVs, we're getting to parity, and there's still speed bumps in EVs. So it's not just the premium. There's also some perception issues. It's sort of wild that China is growing really quickly in terms of EV adoption. One of the good things that I've heard is, well, there's no real baseline, and it's not like they're coming off of like gas powered exhaust sounds where there's a group of people like, hey, I just don't like the way this feels and sounds and things like that. But we think overall there's a lot of mitigation that will slow and is slowing. But what's replacing a lot of the interest is adaptation, right? And so you don't need to look very far to see insurance rates are going up, et cetera, et cetera. The subset of resilience companies generally attracting more interest, growing faster, easier able to raise funds. That probably remains true in the coming years. And then mitigation probably has some gaps depending on incentives, depending on a lot of things, but it's less certain than it was, let's say, 2 years ago.
ClimateTech founders are taking on a huge challenge. Not only do they need to know how to build a startup, but they also need to deal with hardware, have a strong handle on climate policy, know how to fundraise from diverse investor types. It's a lot.
That's why we made Clean Techies, the #1 podcast for climate tech entrepreneurs. In addition to our jobs, we devote 20 hours a week to producing this podcast for you. This way you can learn from the people who have walked the path before you, learn from their mistakes, and gain insights on navigating this complex journey. If this mission resonates with you, we are asking for your help. It takes a lot of effort and it's not free.
If you are already a subscriber and want to help, start supporting us today by going to Substack and clicking Upgrade to Paid. Thanks for helping all the climate tech entrepreneurs like you.
Is that primarily due to policy, the mitigation kind of
No,
waning?
I think policy is always useful, but in the end, like this is still about customers making decisions, right? Whether it's a consumer or a business, and sometimes those decisions are to not do anything, right? A lot of the time, right? So you've got to make decisions about what cement to buy. You've got to make decisions about what aviation fuel. You've got to make lots of things. Now we can try and regulate. I think what we're finding is that a lot of the more aggressive regulations are getting pushed back. Either the timelines are getting pushed back, or the exemptions are increasing. Things like Local Law 97. It's a constant battle just to keep everything under that law. There's lots of people trying to carve stuff out and be excluded. So that's going to be a battle, but it is customers. When you see things like, we have a recent investment in a company called Novoya that does, they're building an electric only truck fleet, like semi trucks. When you get close to diesel, even at parity to diesel truck, like for a shipping route, it's over. Like it's over. Most brands, most large companies are like, oh, same price, let's do that.
Yeah.
And so
is that mainly because they actually have these sustainability commitments, or just because they see the reliability of the vehicles, for example?
Some do, and some are very, very eager to tell everyone that they finally figured this out, right? So you can sort of see. The funny thing was, like, literally on the first day, they were getting calls not from the customer but from the PR agency.
Yeah, that makes sense.
So there's some of that, but they are The bigger conversations about larger contracts are straight, like, ruthlessly economics. And so I think that's good news. Like, I think there are more and more things that cross that threshold where if you win even a little bit, then it really is kind of a tipping point, and off you go. Like, they have overwhelming demand. I've never seen anything quite like it, and it really is being able to show up in the same market, you're selling the same way. It looks, it really looks like a commodity, but it's better. It literally is better, faster, and cheaper. It's like classic tech winning.
Yeah. Yeah, so if you can get that, it's usually game over, right?
Yeah,
Because who wouldn't take better and and cheaper if it's
yeah,
also green, right? That's just another incentive. So okay, I guess, do you have any other thoughts around, like, maybe the bull case if things start to go really well? Okay, you mentioned a couple of things in the presentation around
yeah. I think
if there's some big exits, for example.
I think that there's a virtuous cycle. I think if you go back to sort of what was big tech, 20 years ago, well, it was sort of medium and small tech,
Yeah.
and then a few winners managed to consolidate and buy. So if you go and look at something like Google, after search, they bought things,
Mhm.
right? Android was acquired, YouTube was acquired, can go on. Nest, which is an inspiration for us to even start investing in climate, was acquired. So there's reason to believe that, let's say, I think like Redwood Materials is on the list of secondaries for, high probability of IPO. There's good reason to think that the sort of reverse logistics part of batteries gets rapidly consolidated if they go public, right? Because
Mhm.
they would be the group that has the cash to acquire, that can sort of go through the stack and figure out what pieces they need. And so that's the bull case, is that as soon as you get a few things through, it's not just about the IPO, it's about dragging along a whole bunch of other exits that are likely to be acquired or merged into that. And then similarly, I think in PE, I think what we're seeing in PE is there are areas of activity. So let's say like waste management. It's an industry that tends to have similar structures, but very localized geographically. So if you wanted to do a roll up, that's kind of the best structure. You're just going around and looking for the local player that you want. You roll them up into a larger structure. They can use a lot of the software, the buying power of trucks, whatever it is. But they're businesses like that fit PE really well. So those subsectors, I think, we have some exposure to them. I think they're surprising in some cases, like what's interesting to PE. And then the other thing that's interesting in PE is they've raised an enormous amount of private credit. And so often the way that the VC ecosystem in climate will interact with PE is not the private equity part. It actually starts with the private credit part. And I don't know what that means yet, right? I don't know if private credit then goes to the other side of the house and says, hey, look, we've got this company growing like crazy. Look how much we're lending to them. You should own the equity. I think it's a little bit too early, but it seems like that would be, they have free early signal into the high growth companies that are borrowing. That aligns with the IRA. It aligns with a lot of asset intensive businesses, which is very common in climate. So
Mhm.
those are the bull cases where, you have a virtuous cycle on the IPO front. And then we talked a little bit about CVCs, but then you also have PE getting pulled into an environment where they actually have the first look at some of the most interesting stuff because they've seen the businesses through their credit
Mhm.
arms.
That's interesting. I mean, this goes back a little bit to your point around companies getting bought early. And I always think about that, like, how many of these climate tech companies can actually become the winner rather than just get absorbed by another company. And it sounds like you're saying there's a possibility private equity could come in and back a few of those to try to do it, or you've got some larger companies like Redwood who could IPO and then could actually
Yep.
become their own standalone, like,
So
kind of monster, if you will.
yeah. So I mean, so the all of those scenarios are selfishly, from my perspective as an investor, and from the common stockholder, founders, and teams perspective, of having a large enough exit that they get paid. There is another interesting thing that's been going on for the last 12 months that a lot of our portfolio companies benefit from, which is as the fundraising environment gets harder. So I can talk about the ones that are public. There's a company called Cycle in Berlin. They run e-bike leasing. So you can, personally you can do it, or in the delivery various delivery businesses rent fleets from them. As funding slowed down last year, a bunch of their competitors were less prepared, however you want to think about that, weren't paying attention, didn't have enough cash, whatever it is. But they landed up having conversations with those founders who said, well, actually, I could wind this down. I could sell for a discount, or I could just effectively join your team. So I'll get on the cap table of Cycle, and you effectively get our business. And if I do that 2 or 3 times, we become the leader in Europe, which is effectively what's happening. That sort of mini PE, if you like, and I'll call it mini PE because the amounts of cash involved are quite low. In fact, in some cases, there's no cash. It's just folks saying, I'm going to take equity that I have, which I can offer to someone, which is still more valuable and still more believable than the alternatives, which are really bad. It's winding down or selling at a discount.
Yeah.
So I think that's sort of once in a cycle. I don't think that happens a lot. It's maybe once in a 10-year thing where you have an aggressive correction and venture-backed companies can actually go out and do roll-ups. So we're seeing that.
I see.
Just like for the VCs on the other side of that, like it's great for our companies. We just have companies that grew revenue 3-4 times, became the leader in a category. I'm super happy. If you are one of the companies that got rolled in and got some equity, the preferred stockholders in that deal probably didn't do great. They may get their money back at some point, but that's probably the best case.
Mm-hmm. Yeah, no, I think something along the optimistic view of the future. Maybe I'm being too optimistic, but I think, if we have a change in administration, my hope is that people will use the next 4 years as a way to make climate truly bipartisan, so that you can start to see wins that will then be resilient no matter what's going on, right?
Yep.
And you talked about this kind of focus on adaptation instead, and I think it tends to lean that people who are if climate change is real, we'll just suck all the carbon out of the air, like some of these other solutions or whatever. People tend to be more in favor of those, so we might that would be a case for those pieces, right?
I think the dark humor part of climate is the adaptation sort of, I wish we could learn differently, meaning it would be nice if people could get together and say, hey, we modeled this out. And by the way, this is what I thought. When I was finishing grad school, I got to look at the first LCAs. This is like late 90s. I remember joking with my professor at the time that it looked like an accounting problem. Like climate looked like an accounting problem. And so I was like, yeah, reasonable people, the adults will get together, we'll do the math and of course we'll decarbonize. But I think the unfortunate way is we learn the hard way. The hard way is people have to lose their homes. People have to file insurance claims that don't get fully paid out. It's going to be, and I mean, we talk about it, it's like avoidable suffering. I think that's the most frustrating part of watching this is we knew the answer to a lot of these things, but also getting people motivated, getting the political activity probably requires a disaster, right? Great financial crisis, we did a bunch of stuff. We can argue about the efficacy of some of that stuff. We didn't look at the financial system and say, hey, there's inherent risk. We're like, oh, shit, it broke. We need to fix it. We're doing the very expensive, very difficult version of that with climate.
Yeah, no, that makes a lot of sense. So I do want to recap this here. So we've already effectively talked about the exit strategies, right? So you said engage early with CVCs, generally speaking. The path to PE might be through different parts of the capital stack. I think you explained that through the credit side of things, correct?
Yep.
And then the possible method of just kind of doing a roll up by merging with other companies that are maybe not winning as often. So those are your kind of 3 possible exit strategies for founders thinking right now, if we're focusing on that question of how to get an exit.
Yeah, I mean, the third one, again, I think the third one is live to fight another day. I don't know if those are the types of exits that the investors will be happy about. It's sort of a cheat code if you land up being the acquirer. Just one other way in which that's important is, to get to an exit, you need to be at a certain scale, right? CVCs are interested at any scale, but PE tends to have a minimum kind of viable scale, and the public markets certainly do. And so, but sort of agreeing to be acquired for stock really just gives everyone a better shot, right?
Yeah.
So if you effectively merge 3 companies, create the winner, you've basically said to the PE world, hey, we're the logical target if you want to do stuff in e-bikes.
Yeah, I think it's important though, especially for people who genuinely care about climate. It's easy to get stuck into the fact like, hey, we need to win, but at the end of the day, if you want to make an impact on, emissions, for example, you need to find a way to stay alive, like you said, right? And it may not be the prettiest option, but it's an option, right? Let's see. So now it's been like roughly what, a little over a month since you guys had this event. Like, what have you seen as some of the kind of core things that stuck and some of the things that didn't stick with the people you've had, the conversations you've had post this event? All right, thanks everybody so much for tuning in to this episode with Shaun. Unfortunately, this is the end of the free episode. If you are not a paid subscriber, you can get the rest of this episode by going to cleantechies.substack.com/subscribe and choose any paid option or redeem your one-time trial period to listen to the rest of this episode. But if you like the content we put out, we really do appreciate any paid subscriptions you're willing to send our way. It helps us keep the show going. And then you get access to all of our library, to the full episodes, and to our group chat on WhatsApp where we're talking about different things. Sometimes you get a little bit of a heads up on what's happening, who are going to interview ahead of time, maybe influence those questions even. So if you'd like to hear the rest of this episode where Shaun talks about how to plan ahead for an exit, what specifically resonated from this event, and how M&A opportunities are likely to happen, as well as his general kind of key takeaways from the event and what they learned afterwards, become a paid subscriber today and get the rest of this episode. Again, thank you so much for joining us. Hopefully we'll see you on the other side of this paywall. Take care.